Adjusting entries are accrual-based accounting methods, which record revenues when they have been earned and expenses when they are incurred. The four types of adjusting entries are deferred revenue, accrued revenue, deferred expense, and accrued expense. Now imagine you are a cake shop owner, and a customer has ordered and paid for a custom cake. The following journal entries would be made. Upon transaction, cash would be received and debited, leaving a liability for the business to provide a cake. This liability is known as unearned revenue and is thus credited. Once the cake has been made, the liability has been fulfilled, so the adjusted entry would now involve debiting unearned revenue and crediting revenue. This adjustment is known as deferred revenue, as the earning of revenue is delayed. Accrued revenue is the opposite, where cash is received after a good or service has been provided. Say, for instance, a customer utilizes the emergency wedding cake service, where a cake is provided on short notice and the customer is billed an invoice in the next week. After the customer has picked up the wedding cake, a journal entry debiting accounts receivable and crediting revenue is made to reflect the earning of revenue. Once the customer pays their invoice, an adjustment is made to debit cash and credit the account receivable. Both these scenarios follow the rules of accrual accounting, which requires revenues to be recorded the moment they are earned. Now we move on to expenses. If our cake shop pays for a service or resource before consuming it, a journal entry debiting the resource and crediting cash is made. As the resource is used, we must make adjustments to reflect how much of the resource is being consumed. This adjustment is known as deferred expense. For instance, if a 12-month, $3,000 insurance policy is purchased on our cake shaping equipment, we would list our initial transaction as mentioned earlier. The resource is consumed as time passes, and this activity must be reflected in the balance sheet. To do this, we debit the amount of the resource we have used so far as an expense and credit the same resource. In this example, insurance expense is debited and prepaid insurance is credited. Accrued expenses work in the opposite fashion. When our cake shop pays salaries, we are incurring the expense before we pay for it. At any moment before we have paid the salaries, we would record in a journal entry a debit of $5,000 to salaries expense and a credit of $5,000 to salaries payable. The moment the money is transferred through direct debit, an adjustment is needed that debits salaries payable and credits the cash account.